Happy day, everybody, and welcome back to Mortgage Talk with Mark. I was out last week, so I'm excited to be back in the studio talking about home loans and mortgages and strategies, mainly for seniors. As you probably know, if you've listed it all, I'm focusing my mortgage business primarily in the senior market. Seniors, by definition, is anybody over 62. I'll be 67. 62 is way back in my rearview mirror. But these are my people, and I want to talk about some strategies in the mortgage space to maybe help the senior market. That's where I'm kind of moving in the business after 40 years. So, and as you've probably heard, if you've listened at all, that I have a book coming out that I've been working on for about 6 months, and I actually have it with me. It's not published, but it's in this little binder, and I'm going to reference that today because this is a third part of a three-part series from questions that I've gotten over the years or misinformation, things I want to address around reverse mortgages. Reverse mortgages, by definition, is a government-backed, at least most of them. Some of them are private. We're going to talk about that too, or proprietary type loans. But 95% of these loans that are done are insured by the federal government, by the Housing and Urban Development, Department of Housing and Urban Development, insured by FHA. And so they're very safe loans for seniors. And I want to explore a little bit more today. This is, again, the third part of a series. In my initial title, and here I want to have a little contest. My initial title on this, I have not determined yet what is I'm going to call the book. So my initial one was Texas Gold, the gold mine in your backyard, which is kind of a play on kind of unseen asset that you may not think about in the home you live in. So here's my context for the first person who wants to comment. If I use your title, I'll pay you $500. That's the contest for the day, because I've got to figure that deal out. But so I want to start with a question. And again, these are conversations I've had with people over the years, even before I really got into the reverse space. I knew a lot of people that were doing them or selling them, and so I've had a lot of conversations. And one of them is, this is more of a psychological question. But there's a lot of psychology in this world, in this space, because it is a really important decision about how people are going to handle this question. But one of them is, why do older homeowners, including myself, often underestimate the role of their home can play in retirement planning? And I think about growing up, and my father was, he was a Depression era baby. He was born in 1917, so lived through the Depression, and we were sort of raised to, to be out of debt and certainly own your home, And sadly, the stats are most seniors these days are going into retirement years or potential retirement years with a mortgage or more than one mortgage. I have actually 4 mortgages. So there's reasons to leverage real estate. Don't get me wrong, but we were kind of raised that way. Maybe I didn't listen very well, but when I was growing up, it seemed like the options, if you didn't have a pension, and pensions are pretty much out these days, you'd have your Social Security income, which I just applied for last month. It'll start hitting in September now. Pensions, possibly, or large IRAs that you may have saved up through a 401k. Then you've rolled into a 401k plan. And some people have several $1 million in those things, and I've seen that kind of money. And then personal savings, personal savings are typically designed as emergency funds, but some people have quite a bit of money in savings. So those are the sort of the 3 pillars that most people talk about, even financial planners for that matter. I've gone to a lot of seminars on financial planning and retirement planning, and those are the things people talk about, those 3 items. Sometimes insurance, sometimes life insurance. And rarely, unless they've been educated, do financial planners or financial advisors share with people the opportunity in a lot of people's homestead. I've said this before, but the stats say by the government, I didn't make it up, that about it's estimated that $10 to $12 trillion, trillion with a T, not a B, $1 trillion are held under assets of home equity, residential home equity. We're not talking about commercial buildings. We're talking about where people live. 10 to 12 trillion dollars worth of assets that people don't really think about. And so I think psychologically people are, because it's not like, a stock portfolio or uh, Social Security check. It's where you live. It's where you've raised your kids, most likely, or it's maybe where you raise your grandkids. And so it's not really thought about as an asset that can be utilized for retirement planning. And so I'm here as sort of, I call myself now an evangelist. I've learned a lot about this, and most likely in the near future, maybe next year, my wife and I will be getting a reverse mortgage ourselves. We don't need one now. Actually, we don't qualify right now for different reasons we won't go into. But I think people psychologically just don't think about their home as a potential to help supplement their income. And one of the problems is a lot of fear for seniors that we don't want to be a burden on our kids, obviously, and we're living longer. I don't know what the average age is these days, but it's way up in the 80s. Which was much different than when I was growing up. I bet it's up 5 or 6, 7 years over when I was growing up in the 60s. So psychologically, it's a big shift for people to make. It's a big shift for me, but I'm convinced. I call myself an evangelist. I may have said that because I think it's a wonderful product, and I think it's not for everybody. If you're ultra wealthy, you may not need this sort of thing, or if you're really strapped, it may not be the best solution for you. But I think for a large percent of seniors, this is an option they want to look at. So let's talk. The next question is, what exactly? I'm just taking questions out of the book, and I should have this thing published hopefully in the next, I don't know, next month or two. So we'll see what happens, and I'll be happy to send you a copy. But what exactly is a reverse mortgage in plain English without all the jargon? Well, it's really simple. A reverse mortgage is a mortgage. It's a lien on your property, just like you would have if you have what we call a forward mortgage. Most mortgages I've made thousands of these forward mortgages where people buy properties or refinance homes or build loans. I'm still doing them. I'm doing a loan for a friend of mine buying a lot out in Lakeway for $400,000. He's going to buy the lot and then work on a construction loan. We'll help him with that. But he'll have to pay it back. These loans we're talking about, you have an option of paying them back. You don't have to, which is a beautiful thing. So it is a lien, and it's basically what it is. It's an option or an opportunity for people to borrow a certain percent of their current equity position, okay, on a line of credit. We make a line of credit to somebody if they qualify, and it's fairly easy to qualify. It's much easier to qualify for a reverse mortgage than a regular mortgage, because we don't care necessarily that you qualify with DTI, what's called debt to income. We still look at your credit. We don't care much about your credit scores. We just have a residual formula I won't go into right now, but it's much easier to qualify because we don't count the mortgage against you because you don't pay the mortgage. It's optional to pay it back. So we don't have that mortgage payment in the qualification, or the calculation, I should say. So it's an opportunity for people to supplement their income. There's lots of reasons, a lot of strategies around reverse mortgages. Some we've talked about. I'm going to share a few more today. But the owner still retains title. The bank doesn't take title. It can be paid off at any time or refinanced, or it can be willed. The property can be willed to an heir. Typically, that's the children. And I'm going to show you. Sometimes I got a call last week on some guys, a friend of mine, actually from college, and he's starting to hear me listen. He likes to listen to my little show sometimes. His name is Tommy, and Tommy reached out to me. And I hadn't talked to him for a long time, but he heard me on the show, and he called me and said, "Hey man." And Tommy's a little bit older than me. He's probably 68. We went to college together. We're in the same fraternity. And he said, "Hey, Mark, I heard you on the radio, and I'm in a situation now. I've got 2 siblings. There's 3 kids, but they're in their 60s. These aren't young people, but their parents are in their 90s, I want to say, and they live in a nice home on Cat Mountain, worth a couple $1 million." He said they've got a beautiful home paid for. They love living there, but we're kind of supporting them. We're the 3 of us. The kids are sort of supporting their parents because they don't have a lot of cash or cash flow. They have some, but it's expensive. Things like taxes. You still got to pay your property taxes. That gets expensive. So we arranged what they call the official name is called HECM, Home Equity Conversion Mortgage, where we can convert a portion of that equity into cash flow. And that way it saved the kids, my buddy and his siblings, having to spend $5,000 a month, to support his family, for his parents. And we were able to give them a draw of $5,000 a month from the equity in their home. and all three siblings, uh, were well done, well established professionals, and so they didn't need to inherit the property. It'd be nice, and they will inherit the property because there's going to be a lot of equity left when the parents pass. So that's just one example of how that may work. Um, the other question is a lot of these loans, at least the ones that we're talking about primarily on this HECM product, are adjustable rates. And people get scared of adjustable rates. Now, there is another option for a fixed rate, but the rates are going to be a little bit higher because the adjustable rates can come down to 3%, 5%. Currently, they're around 6.5%. They could go higher, granted. But your fixed rate options, there's two things around the fixed rate option. You have to take all the money up front. And some people that works for them because they need a lump sum money. I had a client one time that had some IRS debt, quite a bit of it. And he had gotten in trouble from it's a long story, but he owed the IRS about $200,000. So we did a lump sum cash out for him. That's what he needed the money for. Okay. And so that worked for him. And he didn't care about a line of credit. He didn't care about anything but paying the IRS off. Okay. So that happens. Now I have a very wealthy client of mine who had a property in Tarrytown worth about $4 million. And he was in his 80s. And he had a lot of money. So, but what we showed him how to structure this thing, and it didn't have any debt. He didn't want a mortgage. He didn't want to have to pay back a mortgage. So I said, his name was Tony. I said, so what we can do, here was a plan. The plan was that he wanted to buy his grandkids a house or a large down payment for a home. His grandkids were in their 20s. And we all know if you're in Austin, Texas, a lot of the young people can't afford buying houses. Now, obviously some can, but there's a lot of people who can't. So he got a mortgage, a reverse mortgage for $900,000 one-time lump sum. That's called a proprietary loan because most of the government-backed loans are limited on how much you can borrow. But some of these proprietary loans for some of these reverse mortgage companies can go to $4 million. So there's an opportunity so you could buy a business from it if you had the equity. In his case, he gave each of his grandkids $300,000 that they could use for a down payment. They could and I did the mortgages for two of them, and they bought properties worth about $500,000. So they only had to borrow $200,000 to get in. They could qualify for that. So that was his strategy. He said, why wait until the end? Why don't we leverage the property today? He said, I might be living another 10 years. But the beauty of it, he doesn't have to pay back the mortgage. The interest accrues on the loan. So let's say he lived 10 more years, rate was around 8%. So he may owe after 900, probably around 1,617. Okay, but again, the property may appreciate to 5 million from 4. So the family will still be well taken care of as far as the equity position, because it most likely is going to keep appreciating, at least over the next 10 years. We've been in a little slump the last few years. So we haven't seen properties appreciate in Austin since COVID. And, but I think that's going to change. But that was an opportunity for another way to leverage equity. He said, Mark, I don't have any debt. I don't want a mortgage payment, but I also don't want to liquidate my assets, but I want to help my grandchildren. So that was a very smart solution. At least he thought it was. Worked for me too. And so when people say, what does it mean to have no monthly mortgage insurance, no monthly mortgage? We're only talking about the principal and interest on the loan. Okay. So as an example, give you an example. I've owned several properties, and the house I live in Lake Wave, our mortgage payment all in is around $4,200 a month. And we pay that every month, whether we like it or not. And so, but the principal and interest payment on the mortgage itself is only $2,800. The rest of it is taxes, insurance, and HOA and things like that. So if I were to do a reverse mortgage on my property, I could eliminate the $2,800 a month, but I would still be responsible for paying the taxes, the insurance, and HOA, and the upkeep. So, it's a way. I'm talking to a man now. He's got an interesting situation. He owns a duplex down in South Austin. He's 72, and he called me by referral about helping him get some equity. He needs some money. He only owes about $100,000 currently. The property's worth about $600,000. Now, in Texas, got some strange equity laws. That's the other thing. You cannot take a HELOC or a cash out refinance on a duplex, even if you live there, because they look at it as sort of an investment property too, because he's receiving rent on the other side. So his mortgage payment's only about $1,600 a month. And I showed him a plan where we can not only eliminate that through this reverse mortgage, but we also can set up a line of credit for about $225,000. Or no, it's not quite that much. It's like $150,000 line of credit that he can access to he wants to put some more money in the stock market and some investments. And right now it's called debt equity. He's got some money, but he has to sell the property in order to access it. He doesn't want to sell the property. So I thought it was a great plan as well to be able to eliminate his mortgage payments. Will save him about, I think it's around $1,200 a month for the mortgage itself. He still has to pay his property taxes, insurance, like we all know. But the tenant pays for that essentially through the rental income. So he can live somewhat debt free as far as cash flow debt free, I should say, as far as the mortgage payment goes, because he wouldn't have one. And so he loved that idea. And so he can have access to cash down the road if he wanted to travel, if he wanted to fix the place up. That's another reason a lot of people do this, is to remodel their properties or to maintain their properties, because after a while you need new ACs and roofs. I put on a roof on our house a few years ago. It was $25,000. Now we lucked out because we'd had some hail damage, so insurance covered most of that. But let's just say I needed to replace the roof and I didn't have insurance or a claim to make. It's expensive. So that would be another reason people do this. Lots and lots of reasons to do this. So let's see what else we want to talk about. The other category that we're starting to see a lot is divorcees. The stat, and I didn't believe this at first. Matter of fact, I did a lot of research on this because I didn't believe it. I'd heard this about a year ago, that the fastest growing segment of divorces is called the silver divorce or something like that. It's referencing people over 60s. It's not the fastest number. It's not the number of people that are growing. It's the fastest percent of people are filing divorce. And there's a lot of considerations for people who've been married 30, 35 years, 40 years financially, and I'm not a divorce attorney, so I can't speak to all that, but I just know that decisions you would have made during the divorce or even before the divorce are going to impact on what you can take. So reverse mortgage comes into play sometimes. Sometimes people will sell a property if the judge deems it the right thing to do, or refinance if they're capable, if they're still working. One party could refinance the note and pay off the departing spouse. But a lot of times we've been using reverse mortgages because they don't want a mortgage payment. A lot of times they're at 60s or 70s, certainly. They own a home maybe free and clear, but they don't have a mortgage on it, and they don't want a mortgage on it. But they also owe some money. So we come in there, reverse mortgage, take some cash out, pay off the spouse, the departing spouse. And the person owning the home still, after the divorce, doesn't have a mortgage payment. Okay. So that's also happened. We've seen that quite a bit. We're getting a lot of calls on that. So we're starting to educate divorce attorneys around this, financial planners, estate planners, all sorts of people around the advantage of this product. And so here's another question that comes up. This came up the other day in a networking group. I was talking in front of this group, and this guy comes up. He goes, "Mark, what is why might not a retired person," he says, "what you're selling it sounds like a HELOC. Why wouldn't a retired person get a HELOC as opposed to reverse mortgage?" And I said, well, it's a good conversation, and maybe they should. Okay. Because we also do HELOC. So I'm going to present everything I know in the mortgage space to somebody who they come to me. And sometimes if I don't have the best deal for somebody, I'll refer it. I had a client, matter of fact, he's closing next week, and he's buying a house up in Dallas. He referred to me. This is on a purchase, so it's a different conversation on some level. But his name's Mark, just like mine. I really liked the guy, but I couldn't help him. I didn't have a product for him to get him a mortgage. So I referred him to a friend of mine with a bank because they portfolio loans. They have their own cash. They make their own decisions. They don't have to go to the secondary market for, what somebody can do. They decide. And they liked his portfolio. They liked his profile, I should say, financially. Very strong borrower, but different, a little different. And so I said, I don't make a dime on this deal, but Mark, call this lady named Jessica. She'll be able to help you. And she did a great job, as she always does. So the same thing in this world here, in the reverse world. If somebody needs cash, or that there's three ways to access cash, and I've used two of these, and the third one is coming, called a reverse mortgage down the road. A Texas cash out loan, a HELOC, which is a line of credit, basically. I have one currently, and or a reverse mortgage. Now, the first two are going to be, there's two things about those. They're going to be hard to qualify for, and they're fixed. In other words, I have a line of credit on one of my properties for $250,000. It's a home equity. I've paid it off. I've charged it up. I've paid it off, and then I can use it like a credit card. But it's fixed. It'll never go more than 250. Okay. Plus, the fact is, I have to pay it back every month, which we do, and it's gotten expensive. Those rates now are up to around 8%, so it's gotten a little expensive. I've got to figure out what I'm going to do about that. But that's a personal problem. So that's called a HELOC. And maybe a HELOC, if you're going to be in the property short term, or you just need the money for a year or two, then a HELOC may be the better way to go, primarily because they're cheap. There's no closing costs. There's hardly any closing costs to those loans. So that's the advantage of a HELOC. And I'm not down on them at all. But the problem is, again, you're stuck with a mortgage payment, and who wants that? Not me. So, but they're also a little bit hard to qualify for than a reverse mortgage. And the other advantage of the reverse mortgage, we've talked about this, but I keep reminding people, because people learn, I think, if they hear things over and over better, they learn better, is the fact that if you have a line of credit through this HELOC, like I said, it's fixed, but if you have a line of credit through a reverse mortgage, it continues to grow every year, around 6%. So if you had a line of credit for 100 grand, next year you'll have access to $106,000. The next year after that, 112. So after time, you're going to have a lot of access to cash if you don't use it. So that's another reason to start early, getting this thing in place at 62. That's the minimum age you have to be, 62. For both parties in Texas. Texas has some weird equity laws. In other states, you could be 65 and your wife 45, but not in Texas. Both parties have to be over 62. So keep that in mind. I've got a buddy now who called me yesterday, and I've known Casey for, I don't know, 30 something years. And he said, man, I need some cash. And I said, well, don't we all? And he said, I got this property at a nice area of Round Rock worth about $900,000. I only owe 100. And I said, well, let's talk about this reverse. He goes, yeah, that's what I want to talk about. He's 66. He's my age, about 3 months behind me in age, but his wife is only 60. So I can't help him. I said, look, you're going to have to come back in a year and a half when she turns 62, because I can't do anything with that product now. So he's going to have to find another solution for a year and a half, Again, that's in other states, he were in Louisiana or Oklahoma or California or anywhere else, he could do it, but not in Texas. Keep that in mind. So we also teach a lot of classes to realtors. I have a providership to the Real Estate Commission, have for 18 years. I'm approved as a provider for CE classes called Continuing Education for Real Estate Agents. I've been doing this a long time. I have a lot of courses approved. And I just got one approved a couple weeks ago through the Real Estate Commission called Reverse for Purchase. It's a 2-hour course on how people that can buy a property in Georgetown or San Marcos, retirement communities like Sun City, can buy a home and leverage their cash to buy more home and still not have a mortgage. So it's called Reverse for Purchase. You can actually buy homes using a reverse mortgage. And it works for a lot of people because, they if they're coming from Dallas or Houston, maybe their property is not worth as much as it is in Austin, Texas, value-wise. So it's a little more expensive down here. So they may take their $500,000 and either buy a property for $500,000 cash, which is an option, certainly, or buy $800,000 and get a $300,000 reverse mortgage and never have a mortgage payment again. That works for a lot of people because they see the advantage if, in fact, our appreciation comes back like historically it does, 3% approximately a year over the last 40 years in Central Texas. Some years are a lot higher, some years are lower. Right now, we've been in a little dip, but my guess is after 40 years doing this, that we may see a more stable market, more appreciating market. So they're saying, if I'm going to get 3% appreciation, why wouldn't I want it on $800,000 house versus a $500,000 house? Does that make sense? It makes sense to a lot of people. So we educate agents on how to do that, how to communicate that, and then we come in and give them a little bit more of a game plan and understanding around it. It's really a very, very popular thing and becoming more and more popular, because most people want to hold back some of their cash to offset taxes and insurance. I mean, it could be $10,000, $12,000 a year for those two items typically. You know, we spent last year around 30 something $1,000 just on property taxes. Now our tenants, of course, through rent will cover most of that actually, but still, um, um, that's another reason to maybe do that. And also, and I'm going to wrap this thing up. We got about a minute to go. A friend of mine who's a financial planner said, "Mark, aren't these loans very risky?" I said, "What's risky about it? I mean, you don't even have to pay it back. How much could you reduce the risk? A HELOC, you got to pay every month, or they'll come take your house." And so he thought about that for a minute and goes, "Well, that's a good point." How about borrowing $500,000 and not have to pay it back? That's a pretty good plan, if you ask me. Now, of course, I'm being a little facetious, because eventually you will pay it back, and you pay it back either at death, or the sale of the property, or when the last person leaves the property, the last homeowner leaves the property for whatever reason, you have to pay that mortgage off. You can't rent the property out. Okay. So I've only got a few seconds left here. If you need me for any reason and want to talk some more, call me at 512-789-6967. I own Texas Mortgage Source. My little banner's in the back there. And I'd love to hear from you and speak with you. 512-789